Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, March 6, 2020. Let's share what I see on the charts. One of the subscribers asked me recently, made a suggestion that maybe a few more static charts throughout the day, chart images, screenshots, because the videos, and I do know this, the videos, if you're working or got other things going on, they take a while to watch. I do like to do them because I can convey all the little nuances that are there, and put a screenshot up on a chart. Sometimes it's simple as break this line, we go up, break this one, we go down, and it's not always that simple. There are other factors in there that come into play. Plus, you can often tell from my tone and in the words I'm using, how strong my convictions are on a move or a scenario in the market or direction. And of course, I like to throw out all the possibilities, because this stuff is not straightforward, and anything is possible at any time. So let's just do this video now for those of you that have time to watch, and I'll kind of go over some of the things that stand out today. All right, so this is the QQQ official short trade we entered the other day. Came close to, tried to run at our stop, but unfortunately it was placed just at the right level where we didn't get stopped out, and it's playing out so far pretty well. We're still only about halfway or so to our sole price target here, 195.35, and depending if and when that target is approached, possibly I could extend the trade, but we'll see. Let's just leave it at that for now. What I always say is, if you think there's more downside, or you want to just be open to the possibility, what you can do, there's many different ways to trade. One of those would be as you start to get down close to that level, if you take out this 200-day SMA, 200 or SMAs right here, 200-day simple moving average, which is right around the Friday's lows of last week, 200 days there. So if we start to go down, what you can do is, when you get down here, you can set a stop, a trailing stop. And what that allows for, let's say the market just has one of those meltdown moments where we smash right on through that support level and head on down to the next one. I could give you another level here right now, give or take around this level there. There's certainly some support right here from these lows. So if you want to hold out for additional targets, then set a stop. That way what will happen is, if it's relatively tight, when I say relatively tight, relative means relative to the current environment. These are daily swings right here of 3, 4, 5% or more right there. There's a 5%, and that's just from the low to the high. So relative means wider stops now than you would have here. These are little tiny candles, and you want, back then, tighter stops when you're trading. If you don't use wide stops here, you're all but guaranteed to get stopped out, unless the market's in free fall. That's the one good thing about a relatively tight stop. If it starts to have that kind of meltdown moment, here, I'll show you what it looks like back here. In the leading up into the drop in the bottom of December 2018, you get a pretty unidirectional move down. There were little kickback rallies along the way. So, all right, so that's one strategy for you. Let me just give you the pros and the cons of what I'm seeing right now for the bearish case. This gap down cannot be, at this point in time, construed as anything but bearish, in my opinion. I don't think there's any way to possibly spin it as bullish. What we had here is a move down. I'm going to turn off all the lines here. We had an impulsive leg down. I had quite a few inquiries on the site recently. Hey Randy, is this this move up, is this a bear flag pattern? My answer was no, it doesn't really fit. It's a little too large in relation to the flagpole. Flagpole is your impulsive move down. What a bear flag will usually look like is an impulsive leg down followed by a relatively smaller area of consolidation on low volume, number one, declining volume, followed by a breakdown, and the measured target is the distance of the flagpole added to the top of the flag before it breaks down. So this would be a little bit big, but however, in each of those replies I've said the same thing. It's the net effect of a breakdown below that, we'll call it a flag, is the same thing. What I mean by that is, go back to the 60-minute chart. We had an uptrend line which was revised yesterday, uptrend line off last Friday's lows, very well defined. And so that would be, if you want to call this a bear flag, it would be the same level. In a bear flag pattern, it is only a potential chart pattern like any pattern. And the way a bear flag pattern works, or turn off all these lines, use my drawing tool, is you first recognize it with the impulsive leg down, then you see an area of consolidation on declining volume that works its way up. You take an upward bias there, and then you have another impulsive leg down. However, the consolidation part is only a potential trade setup pending a sell signal. Like any technical chart pattern, bullish or bearish, it's pending a sell signal. Sell signal in a bear flag pattern comes on an impulsive breakdown below the flag. And so again, whether you want to call it a bear flag or not, semantics really. It's because most importantly you had a very well-defined trend line that broke down yesterday impulsively, and now we've seen continued impulsive selling. We're down, even with the snapback rally this morning, we're still down 2.5%. So again, from the daily chart, check mark for the bears, no question about that. Well, this is a 60-minute chart here. We have the PPO crossing down back below the zero line. It's not deep below it yet, so it's still anybody's game, but we did have a bearish crossover yesterday, so these are additional check marks for the bearish case. I have some reservations here, as I shared this morning on one of the posts, and we'll get into that real quick here, but let me just follow up and see if there's anything else. So remember, we still have some pretty solid support levels below the 200-day simple moving average, which came in at Friday's reaction low, which is also a logical support level, a key reaction low, and then the 200 exponential moving average. There's a simple down there and exponential. So like I said, that's bearish. It doesn't guarantee we head lower. We were oversold recently. We're a little off that oversold reading now, and some of the things giving me pause right now are the fact that it's really on the futures and the more so the risk-off assets. Let's get to those. Again, these are everything. I'm kind of reviewing what I covered this morning. So here was gold. Gold, if you back out what you think is going to happen in the market, and this again is why I look at these risk-off assets, and I said it this morning, because they can often give you clues, especially Treasury bonds and quite often gold, as to what's going to happen in the stock market. So although looking for a bigger drop, this is giving me a little pause. You have gold rallying into that previous reaction high, went nearly parabolic there. Very strong advance right up to that 1692-ish resistance level. I was pointed out this morning, and it put in negative divergence right there. It's a big part of my trading. You look for these divergent highs right here, divergent high, correction. Divergent high, correction. So now these divergences could be taken out. Gold could pop through here and run and burn through the divergences. However, it went on to reverse, had an impulsive rejection, already hit that first target and then some. That was that first target zone there, broke the trend line, and we're below the trend line right now. So this is somewhat of a sign of non-confirmation right now for the bearish case. And if gold snapped back, it was a momentum fueled overshoot, and we broke and reversed quickly when the market popped and rallied into those targets. But look, we're right there as I'm doing the video. I don't know if you can make it out, but I think the candles are so small here. Let me roll the cursor here and make them a little larger if I can. Zoom in a little bit tighter. There, you can probably see them now. Small little dojis, but gold is hovering right here. So gold is technically triggered a sell signal breakdown, had a quick move down, brief momentum fueled overshoot off my first target / support zone, and it's still underneath. It's back testing. So if this chart plays out the way that the technicals indicate, no, it doesn't mean it has to, but gold goes down. So watch for a break of this support zone, especially this previous reaction low. And there's other levels. I'm going to give you one right now to watch if you are trading gold actively or in it long, concerned about where to stop out if the market reverses or if gold reverses. That's the thing, guys. I talk about these relationships of risk on, risk off assets, the inverse relationship that they have to the stock market. But there are times where you don't see that. We saw a correction in gold recently, and I talked about it at the time. It was going down when the stock market was going down, and that was most likely margin call, forced margin call selling. There's been gold's in a bull market. A lot of people are long gold in bullish, and because the technicals have been. But when you get too many longs, and let's just say you were long the equity markets because they were also in a bullish trend, and you were long gold, and you were using leverage, and that big drop hit the other day. So your stock longs, I should say, equity longs are going down. Your broker issues a margin call, and you either have to sell. You have to sell what you own. And let's say you own equities and gold, and if you don't sell it, guess what? They sell it for you. That's how margin calls work. They blow you out and they decide what to sell. So anyways, that's what I think happened then, and then gold of course sprung back, and right now it's broken down technically. So I am a little bit suspect of today's breakdown in the equity markets that I just showed you because of this. And now let's look at silver. I showed you silver as well. Gold's really of the precious metals, more of the risk on asset, because silver, they both have industrial uses, precious metals as well, jewelry and such. And then finally, both being a flight to safety asset. But the thing is more so that silver will follow its big brother gold. And silver, boom, ran up there, that 1750-ish level, which I said was pretty significant resistance, and then went on to break down. So there was a short trade to be made, hit that second target, and that was a pretty good target. That's the one where I was targeting today. Boom, got out of that with a nice little pullback trade. There could be more. Here's the thing. Look at that divergence, negative divergence there. Look, last time we had negative divergence was right here, and I pointed out at the time, and it dropped. It dropped more than I even figured it would drop at that point in time. And so, like I said, divergent high, you just have to be on the lookout. The same thing here. Rally, 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 and rallies are fine until you start getting these negative divergences. These are simply momentum indicators. That's all these are. It's not magic. And what a divergence shows you is during an uptrend, everything's good until you start seeing divergence. It's just showing you the trend is losing momentum when you see the negative divergence, and it puts you on the lookout for a potential trend reversal. Obviously, you don't want to just short the first time you see divergence, because that's not a sell signal. What is a sell signal is a break of support like this. That was your divergent high, and that was your sell signal. Again, pointed out at the time a few weeks back. And again, this one as well. Divergent high. It's even better when you get a divergent high into resistance. And basically, that's what you had here. You were at that previous reaction high, and here you had negative divergence, bearish rising wedge pattern into resistance, and we broke down. So that's it. So you're seeing, the precious metals down today with the stock market being down, and that is again just a little bit of a gives me a little bit pause as to will we break those lows despite what happened today with that gap down, or are the buyers going to step in here? Is there something we don't know about? Big buyers going to step in, institutions. It's simple. If there's more buyers than sellers, the market goes up. Whether the buyer is the government, whether it's banks, brokerage funds, or hedge funds, or individuals, it's all collective. More buyers than sellers, the stock will go up. More sellers than buyers, it's going to go down. It's that easy in the stock market. All right, those are levels to watch. Kind of everything I said earlier. Like I say, I'm just kind of rehashing what I did earlier. Treasury bonds have gone nearly parabolic. Parabolic runs usually don't end so well. So while we can continue to go parabolic, please understand that overbought is not a sell signal, just like divergences are not a sell signal. But should the market catch support and rally, especially undo a lot of today's bearish technicals, in other words, recoup all of today's losses and then some, or even part of them, treasuries can break down. So you might have, if you're an active trader and you're nimble, you want to wait for a sell signal. We've already have it in gold and silver. Treasuries break down, you're looking for about a 2.4% drop, from even better, about 2.5 from where we're at right now. That's a nice trade on ZB if we get it. So there's a setup for you guys. I gave you the comparable levels on TLT, and if we break this trend line, I could add some levels in here, which I'll do for you now in case you're a ZB trader. And things move fast, so I like to get these levels out to you in advance so you have them on your charts. Maybe you can align them with your own analysis or see whatever. There's a couple levels there, and you have a trend line coming in here. So if we were to really have a surprise rally, markets somehow pull out a stick save today or early next week and rally, then here's your potential targets. First target there, expect a reaction. If that level goes, that's about 173, 159 plus the trend line. There's your other potential targets, and I think a swing down here is possible to this trend line right here I have. In fact, let me see if I can draw any different here. Yeah, it's just about the same trend line. I should have it extended back here. Let me do that for you. Yeah, the more reactions you have on a trend line, the more valid it is. And so there's a trend line that hasn't been visited in a while because treasuries have started to go, recently parabolic. Very strong advance, and now parabolic in this move. So that would be a drop. So when the next rally comes, we will. Treasuries are, I'm telling you, there's a big drop coming when the market finally, it doesn't even have to bottom. It just has to have a near-term bottom and get the first good counter-trend rally, just like the one we had over last week until recently. There's about a 7% drop down there to that 165, 216 plus trend line support right there. And I gave you comparable levels on TLT today for you, ETF traders. And if you don't short, but you like the idea, you can always use TBT. This is TLT. I just want to show you those two comparable trend lines right there and comparable levels. You can see some gaps right here to target. And then TBT is a 2 times short Treasury ETN. You'll just have to take this chart and replicate those trend lines. This is in reverse. This is like a mirror of TLT. Remember, it has 2 times leverage, and you can then buy this instead of shorting TLT or ZB if you don't trade futures. And speaking of futures, all right, so here's what happened this morning. Starting out, I'm zoomed in. This is that NQ 60-minute chart. So this morning, I pointed out we were coming up or right at this 83.70-ish support right here, and ES was a little bit above comparable support. So I said if the market's going to bounce, here's where it's going to bounce, and this is a likely target right here, 85.05 rounded up, 85.0557 rounds up to 85.06, and that's what we did. We bounced up there. That was about a 2% rally, good for a quick trade. We reversed, and I'm still on watch. Again, if we break that out, it's not looking so hot right now because we faded back a little bit below where we quote-unquote should have bounced. I put up some short-term 2 and 5 minute charts earlier, but still be on watch for that. We already hit it once. If we get back up to it again, if the markets can somehow power back up, we will probably pop it. And what will happen is, what would cause that to happen? Maybe there's too many shorts in the market right now. Maybe the market's reached a near-term selling climax. And of course, the bottom of the range, we have some lows that spike below it, but pretty much a solid break here should open the door for a move down to that low from last Friday. And then, as I said, if we get there, probably take that out and continue down to that target. So, if you're swing trading, these are levels to watch that could change the near-term outlook for the market. Here's a trend line. I need to extend that off the highs right there. Another potential trend line, which could be a bounce target too if we break that. You have a little bit of minor resistance there, but those are levels to watch. And I still think there's a decent chance this can happen today. And I'm going to get to that in a second here with the VIX and show you that again, which I posted on the home page today, but I'll get to that in 1 second here. I want to show you ES. Okay, this morning as NQ was at support, remember you want to look at these two collectively. So NQ was already at support and ES came close enough to that 29.01 support, and that did the trick. Again, you don't have to hit these levels to the penny. Plus NQ had already hit support. So I always say, it's the first of that gets there. You may get a bounce. And so we certainly did bounce. Now we came to this uptrend line right here that I added in that 29.75-ish target right there. So we bounced back, hit that, and it's a pretty important resistance. You can see all the levels starting right here. See these reactions here? Go back, there's more reactions around here. Obviously, a couple more reactions right here where I'm at, and these reactions here. So that is was and still is a significant resistance level there, and that was a logical bounce target. So kudos to you that caught it for the bounce and or reverse their short. Where we're at now, the market's kind of hanging in there. It hit that level. It could have taken an impulsive leg down, but it hasn't. It's holding up. We've been whipping around here. We had a bearish cross. Looked like that we were about to cross. The line started to flatten out, but it's still the potential. We're either going to, what's going to happen today? I think we're either going to take another jog down, probably take out those lows maybe before the close, or on a gap down on Monday and then get a rejection here on this potential bullish crossover on the PPO, or we cross over. We power back up. Here's a trend line. That would be your first objective long entry or buy signal if you're actively trading. Maybe cover your shorts, go long if you want to. However you want to trade it. Again, it's up to you. And then of course we already tested 29.75 once. If we get there again, especially if we pop it, and you have an alternative trend line just above it, that's probably going to trigger a pretty good short covering rally and potentially foil our trade. Well, I'll leave the stops as is. That's the one thing I say. Have a trading plan. If you're a swing trader, all this short-term stuff can whip you to pieces, and it's not going to completely change the long-term, the daily charts, and the basis for putting on that short trade the other day on QQQ. But I just wanted to show you some levels in the near term that could spark a rally today. Or spark the next leg down if taken out. So that's it. We're, again, to keep it super simple, pretty much we're boxed in today's trading range and last night's trading range. That's it. Bullish if we pop it to the upside, bearish if we pop it to the downside. All right, and then finally, old Mr. VIX. Let's look at the VIX. That's the volatility index. Put up a chart today showing the VIX at a long-term resistance level right here. Where'd my line go? I have lots of different boards here, but there it is. That's the one I was looking at. Busy. This just shows you all the, if you look at the notes here, and I've shared this chart many times over the years, same stuff. The VIX is like trading the stock market in reverse, like a mirrored index of the stock market, where you get these divergent lows on the VIX. You'll often see divergent highs on the stock market, the S&P and the NASDAQ, and these divergent lows, what I look for to trade the VIX. You get these rallies, rally, divergent low, rally, divergent low, rally. You can see all they're marked on. Let's not go over all of them. But the important thing about the VIX is a fairly simple creature when you step back and look at it from a longer term perspective. It has a floor. It's not an absolute floor, but it's the bottom of the trading range. The VIX doesn't go to zero. It's not technically bounded by any numbers, but when you look back over time, it has a ceiling. And then within there's resistance levels and different ranges that it trades in. But you can see, going back, I rolled back all the way to 2014. You can go even beyond there, and you can see that in the past, several years, the VIX has only been to this level 2 previous times. And both times, it only touched that level briefly and fell sharply. You want to know how sharp? You don't want to be long the VIX when the music stops on a correction. In other words, I always talk about the music stopping on a rally, like how quick the stock market can fall, which we've all seen recently. But the same thing happens in reverse. When the buyers decide, when the market decides that the correction time is over, at least for a bounce, the VIX can fall in a matter of days, drop 50% or more, 50, even 60, 70%. Very sharp drops afterwards, 75% drop, and so that's it. Just because these were the highs in recent years does not mean that the VIX cannot go any higher. Again, the VIX is not a bounded index. There's no limit on to what it can go technically speaking, but we know that when it gets this high, why does it get this high? Well, the VIX is a measure of it measures put and call buying. It tells you that there's been a tremendous surge in put buying, as I talked about. All those hedge funds and pension plans that got caught off guard because they got sucked up in the bullish belief that the market was just bulletproof and the economy was bulletproof and nothing could derail it. And so all of a sudden, market drops 15+%. They got to start scrambling and cover their downside, and they do that by either selling longs or buying, or shorting, or buying put protection as well as individuals, and that's what we did here. So when there's excessive bearishness, excessive put buying, that usually marks at least a near-term top, as you can see. So therefore, as I'm doing this video and you can hear my thoughts, I'm a little, despite today's technical breakdown, that gap down below those levels, I'm a little less confident, if you will, that that final target is going to be hit, at least without a decent bounce first. We could still, if it does happen and the markets want to bounce, they can still, let's go back here to QQQ, let's go back to that official trade here. We could still bounce and stay below the stop, and do something like this, take a sharp leg up here, and then go down. Anything is possible, but I'm just saying that we could run up, hit the stop, and go down. There's still a ton of overhead resistance, but the VIX alone, and on that I shared a trade idea with you guys, and I actually started taking a small position of this inside of my swing accounts, IRAs, today, and I'll add to it if certainly I'll increase it substantially if I see pretty strong evidence that we're going to rally here soon, today or next week, depending when that is. That's just XVXY. There's a few out there. If anybody knows of one that's more liquid, I think this one, it had pretty decent volume, and the spreads, when I bought it today, let me see if they're still that. They were only 1 penny. So there's a lot of liquidity in this. It's trading, at 42.09 by 42.10 right now, and that's all day. It's been a one cent spread, which is as tight as you get. What I'm getting at, when you go to the other inverse VIX ETFs or ETNs, they if they're very illiquid, they tend to have larger spreads. It's harder to trade, especially move fast, because your options put a limit order, and you're going to keep missing that. Limit order is not going to get filled in a fast-moving market. You're going to keep having to revise it, chase it down, or you put a market order, and then they're going to fill you at whatever they want. So try to stick with, any time you can stick with a more liquid instrument over one that's, tracking the same index or sector that's less liquid. You want to go with, err to the side of liquidity there. All right, let me give you. I already gave you guys targets. That was posted there. Let's see. That divergence is hanging on there by a thread. We'll have to reverse soon in the markets, and if so, here's your PPO signal line. This line can move up quick, and you can still have that divergence. So if we rally from here, you're talking to you have a trend line here, but it's not. I'm not putting a lot on that trend line. I think we'd pop up here. The VIX, any half decent pop in the markets. Should we somehow go flat or even close to flat in the markets today on a pretty sharp rally, this thing can pop up 15% in the blink of an eye. And so again, I'm viewing it as a partial hedge to my swing shorts in those accounts. It can go down too. Don't get me wrong. This thing, when it wants to drop, here was just, this was, when was this? Thursday. Here it was at one point yesterday, trading around 50.32, and now it's down here to it hit a low. It's right now about under $42. It's about a 16-17% drop since then. So volatility cuts both ways. Don't take anything that you haven't calculated what you're going to lose in dollars. Don't focus on these profit potential price targets when I talk about 20+% gains, potentially a 40% rally in this thing in short order. If the market can really get up and rally here, that target there would be about a 23% gain. So don't see dollar signs and say, wow, 23%, 40% potential. You got to also look at what if the market breaks support, it has another sharp leg down, and the VIX does go higher. You got to protect yourself. But like I said, I like it. I like the risk reward right now because the VIX, I think the upside is minimal. You can even see the market go down, by the way, guys, and this is why I know I'm just talking here. But I've done this long enough to tell you that just like treasuries will often, and gold will often stop going up before the market bottoms during a correction, and sometimes they'll start going down like today, and that's kind of an indication that, hey, maybe the correction's about to be over. Smart money is now moving out of treasuries. They don't want to wait till it's clear bottoms in. They think it's coming, so they start selling treasuries early. So the same thing will sometimes happen in the VIX. Well, you'll notice the market's continuing to fall during a correction, but all of a sudden the VIX isn't going up anymore. That can be a tell as well that hey, maybe a bounce is coming. So we'll watch it. There it is. And like I said, still pushing up right around that top of that range, and we'll call it a potential setup. I may add it as an official trade, but it's going to take a little more right now because, as I said, if we just take today's gap down on face value, this gap down here, it's bearish right now. So the market has some work to be done. I covered those levels already for you on the futures. Here's QQQ on the 60-minute chart. And by the way, guys, if I don't get to these 60-minute charts and you want to know, well, what level will do the trick on the on QQQ, it's a messy chart there. We'll go back to a 60-minute, pretty much today's highs, because that's going to be today's high in the NQ, in the NASDAQ 100. So if we can pop up above, today's high is 208.51 in QQQ. SPY, remember SPY ran into its comparable resistance that I had on that, or ES did on that 60-minute chart, and that would also correlate with the high in SPY, which was 297.97. So pretty much you pop those levels, and you can see it's just around that 297.50ish resistance. There's a big old gap right there. If it can pop that level, it may want to go ahead and fill the gap right here. And if it were to close all of today's losses, that would be pretty bullish. You'd probably see some short covering. It would have to, from here, we'd have to rally about 2.5%. I mean, certainly doable, but again, this is quite possible too. Look at the technicals are not looking good now. Bearish crossover. PPO is now solidly back below. This is that rejection I was talking about here on the PPO signal line. Rejection off the zero line. Gap down. So I wish I could tell you with the utmost degree of confidence this is about to happen. Still leaning that way. That's still where the swing trade will remain. But as an active trader, you need to, you should watch for these levels. And these are the things that could kind of catch the market off guard and kind of undo some of the technical damage that was done today. Let me wrap it up here. Video was long enough, but hopefully you guys know my thoughts. And if it's confusing, because things can go either way, that's trading. This is when you're playing at this level, you have to react fast. For me to sit here and tell you with the utmost degree of confidence the market's going to drop down to that first target, just sit tight, don't do anything. Again, it's if you're swing trading and you got in QQQ, we got in at a good level on QQQ. We'll wrap this video up here after this. I just want to say, we're profitable on that trade. We entered that trade at around 212.57, so somewhere around here. And so, it's profitable right now by about 3% or so. So there's nothing wrong with lowering your stop, to your entry point to at least assure a break even, so you won't lose anything at this point in time. I think that's reasonable. You could even lower your stop to protect profits, and maybe above today's high, like I just talked about. We ran up there earlier. If we pop today's high, we're probably going to run more if we pop today's high in QQQ and SPY. So there's another, that would be a tight stop. You're only going to have a relatively small profit on the trade, maybe 2%. But hey, profit's a profit. Or you just leave it there and know that even if we pop today's highs, it may just be noise within the bigger trend. And if you're, like I said, you have a trading plan, you want to stick with it, give it a little room, whether we do this, or this, that is still a very likely target down here, that 195.35. All right, we will wrap it up here. And again, I'll continue to post screenshots of charts throughout the day in both either new front page posts or in the comments section below the previous post if it's related to whatever I covered there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.